Okay, let's get started. So we'll be done early. Be done in an hour, I think, for sure. Let's see if I'm right. Okay, so hooray, one of our sessions is done, right? We've done our non-resident kickoff, IRS requirements. So all of that general stuff about standards of conduct, intake interview, all of those things apply for resident taxes as well. It's really just two different sets of tax laws. So we're going to talk about that. All right, we're going to talk about resident versus non-resident. We're going to talk about tax filing basics. Then we're going to talk about two really key things for residents, which are filing status and dependent. We're going to go through a bunch of information about them. All right. So how would I compare and contrast resident taxes versus non-resident taxes? So I will be totally honest, right? Resident taxes, there is more information in there. Non-resident, there's less information, but it's all very, very specialized. It's all kind of its own unique kind of rules. There are two different publications that provide information about them. The IRS 4011 is this little guy. It is 40 pages. The big ones from the 4012 are something like 300 pages, something like that. So there's a lot there. As a resident, you have to pay taxes on your worldwide income. As a non-resident, you only pay taxes on your US income. But that's not such a big deal. The really important thing, the thing that makes the most fundamental difference is that the tax software that we use for resident returns is designed for resident returns. It's got built-in guides, it's got lots of assistance. Occasionally there are a little bit of issues as they're updating the software, which they're doing. Like right now, they released the first version. It's always a little bit buggy, but by the time the tax clinics are happening, it works really well. And it actually can help you prepare the tax return. The tax software that we use, it's the same software. It can be made to prepare most non-resident returns. However, there are no built-in guides and there is no assistance. And upon occasion, you have to enter something wrong to get the return to come out right. So, for that reason, when we do our studying and practicing for the IRS tests, for the resident taxes, we use the software, right? It's designed for it, it works really well, it helps you out. Why wouldn't you use it? If it's allowed, and it definitely is allowed. However, for non-residents, for the IRS test, we do not try to teach the software. We just do it by hand. You don't have to do huge amounts of calculations to do the non-resident return. You would spend more time trying to fight the software to get a correct return, when really what you need to learn is the tax law and what a proper return looks like. So you're learning the software and the tax return, the laws and the forms, as opposed to the tax software, which is very different. And we will do software for non-residents in the spring. So those are the main differences. More information, but a lot of help. Less information, specialized, but you got to kind of know what you're doing before you start trying to mess with the software. All right, and then again, I already talked about this, but I'm going to say it again, right? Reference materials are your friend. We don't think you're going to remember everything, right? Heck, I don't remember everything. I don't want to remember it all. It's too much, right? What's going to be really important, even more so for the resident returns, is that you learn how to find information, all right? Our training is going to cover the materials to help you pass the test and be successful. So I will admit, we will spend a lot more time and practice on material that you're going to see frequently at our tax clinics, right? So as you can imagine, a lot of our clients are students. So education benefits are a really big deal for them. Retirement income, not so much of a big deal for them. We're going to still talk about retirement income because it's part of the certification test. You need to know it. But when we focus on our efforts, we're going to focus on the things that you're going to see a lot so that you can be good at those. And again, I'm going to remind you, right? Ask for help. Please always ask for help. We're not going to give you the answers, but right, one of the big things here is learning how to find the answers yourself, and we can help you do that. And we want you to be successful. All right, so we're going to start with some tax filing basics. All right, and let's be honest, right? Taxes are, I would say, right, they're an ongoing experiment in social engineering. We've had about 100 years of the government passing various laws to decide who should pay taxes and how much they should pay. Various groups over time have used those rules to try to encourage behavior that they think is good. This can be things like getting married or having children or buying a home or getting educated. And as different groups are in power, they generally modify the rules. They don't just like start over. They say, oh, we're going to just change it a little bit here. And this has resulted in a very, very complicated tax system. And it's also resulted in a tax system where the amount of tax that you pay is very dependent on your personal details of your situation, right? So that's one of the things that I actually love about taxes, right? Is nobody's ever the same. There's always something different and unique. Everybody's tax situation is different. All right. So if we had to break it down into like a really high level, I would say if we look at what is a general tax equation, we start with income. We subtract adjustments, exemptions, and deductions to get taxable income. We take that times a tax rate to find your total tax. We subtract credits, we subtract withholding and estimated payments to find out, is it a good day and you get a refund, or is it a not so good day and you owe money? So let's talk really briefly about what each of those are. So I go through these because remember, a lot of our, at least our international students and some of our resident students, right, they may not know what these terms mean because they may never have filed before. They may have filed under very different circumstances. All right, in the simplest terms, right? Income is money coming in, right? Give me that money, show me that money. Adjustments reduce your income based on money that you have spent or saved. So if you spent it on the right thing, you get money off on your taxes. Exemptions reduce your income based on people. It's currently at 0, but the law that makes it 0 expires in 2025. So if you're here with us in a couple of years, we may have a very different conversation about that. Deductions, those also reduce your income. The standard deduction reduces it by a set amount. The itemized deductions, again, reduces your income based on the money that you have spent. If you spent it on certain things that the government has said are great, then that will reduce your taxes. The tax rate is the percent of your income that's paid in tax, and the tax rate is progressive. So it starts off at 10%, then it goes up to 12%, and up from there. So as you earn more money, you pay a higher percentage on those levels of your income. Credits will reduce the amount of tax you owe. Sometimes they only go down to 0. That's called a non-refundable credit. Sometimes they will actually give you money back. That's a refundable credit. Withholding is money that was taken out of your income and sent to the IRS. And it's sent directly to them by whoever paid you. This is not money that you sent in. Estimated payments are money that you send in. You say, pardon me, I know I'm going to owe money to the IRS. So here you go. I will give you some every 3 months so that I don't have to pay so much when I file my tax return. All right. The next thing is who has to file a tax return? Again, right, rules all about your personal situation. So it's going to be based on your filing status, which we're going to talk about, how much income you have, and your age. Even if you don't have to file, you may still want to file because you might get a refund of any tax that was already taken out, or if there's a refundable credit, you might get that even if you never had to pay any tax. Our reference publication 4012 has the charts in the info. This is just a snapshot of one of the charts. Everybody will have the links to that, and we'll have copies of the 4012 for the tax, should have them for the tax tests and for the tax clinics as well. So you can all look up that information as you need to. All right, here are the basic forms and schedules. So the form 1040 is kind of the main tax form. So you'll hear people talk about it. Oh, the 1040, what's on their 1040? That's the main kind of summary tax form. There are schedules 1, 2, and 3 that basically have some additional information. There's additional income and adjustments, right? Adjustments are a subtraction from your income. Additional taxes are on schedule 2, and then additional credits and payments are on schedule 3. I talked about how you can have the standard deduction, which reduces your income by a set amount. If you do the itemized, which is like based on money that you spent, that goes on to Schedule A. And these are some of the things that you could spend money on that might reduce your taxes. So medical or dental expenses, state or local income tax, interest that you paid, like for a home mortgage, charitable contributions, and there are some others as well. And then beyond this, there are many, 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 many other supporting forms and schedules, right? We're not going to go through every single one of them. What we are going to teach you how to do is how to find them, how you define those the instructions for filling them out if you need to, and make sure you at least know what's going on with them for the tax test. When you're filing a tax return, you're only going to include the schedules that you need, right? So if somebody, for example, is using the standard deduction, we're not going to include a Schedule A with itemized deductions because it's all going to be zero. There's nothing on it. All right, to one of the people's Noah's question earlier. So when tax returns are due. So tax years are basically calendar years. I would have an asterisk because it's almost always, right? Theoretically, you should have a calendar year. And taxpayers are also cash basis, right? So it matters like when do you actually get the money, right? Not because I promised to pay Zihao $10, but I didn't actually give him the money until January. That would be January income in 2024, not 2023. Our tax returns are going to be due on April 15th this year, which is great. We've had some random days due to holidays through the past 2 years, but this year it's nice and easy. It's on the traditional date. All right, we will generally be e-filing all of our returns, federal and state forms, so we shouldn't have to mail things in. There are a few circumstances where forms can't be e-filed. In particular, one example of that is when a Minnesota return for a married individual when the spouse does not have a Social Security or an ITIN, which we can see with our international students. If their spouse is back home, but they've been here for 5 years, they're a resident or a non-resident, either way, and they're filing a return, but their spouse doesn't have a tax ID number, then they can't e-file their Minnesota return. They've got to file it on paper. The mailing address is going to be based on the address of the person that's filing their tax return. The software will print that address out for us if they need to do that. So we don't generally need to worry about that. But it's not common, especially for residents. It's not common to have to e-file or to paper file a return. All right, so let's talk about filing status. So filing status is, think of it as like a category. So all taxpayers, they choose a category of what their situation is when they file. And there are 5 of them. They're called single, head of household, married filing jointly, married filing separately, and then qualifying surviving spouse. And each of these things will impact their tax return. Each of those different categories impacts their tax return. For a married filing jointly individual, one of the things that we need to know is if they live together the entire year or not, or live together at the end of the year, pardon me. And then there are some, hang on, let me just close out there. Okay. So some of these criteria require that you have a dependent, you have somebody that you're taking care of, right? The single is not that way, married filing joint is not that way, but head of household and qualifying surviving spouse both require that you have a dependent to be eligible for that status. All right, so the filing status determines the amount of your standard deduction. Remember I said everybody gets a set amount. That amount varies based on your filing status. If you are single or married filing separate, that number is $13,850. Joint returns or qualifying surviving spouse, $27,700, so it's double. And then head of household is $20,800. We'll talk about standard deductions more next week, but some other impacts that the filing status has. It impacts who has to file, and it also can impact the credits that you're eligible for as well. In particular, there are several credits that you cannot file for if you are using the married filing separate status. All right. All right, so how do we figure out what is the right status that we should use for somebody? All right. Sometimes there is a choice. sometimes there is not a choice. And generally for single, there is not a choice, right? So you can file as single if you are unmarried on the last day of the year. What in the world is going on there? And so unmarried means either that you've never been married, that you are divorced, that you are legally separated with a court decree. So not just living apart, but like legally separated, or you are a surviving spouse, but you don't have a dependent to qualify for that surviving spouse category, right? So essentially single, right? There's no choice, no option in either any of these these things, right? This is always like, this is what your situation is. That is what your filing status is. So a couple of examples. So Scott was married, but he got divorced on December 30th. He has no children. What would his filing status be? And the answer is single, right? Because he was divorced on the last day of the year. So for tax purposes, it doesn't matter what else happened during the course of the year. What matters is that very last day of the year. Are you married or not married? So if, for example, his divorce had been finalized on January 1st instead of December 30th, he had no dependents, what his filing status be? He would have to choose one of the married statuses. So he would get to choose, is he going to file a joint return with his spouse or file separately? But he has to say married because he is still married. And that's something we see for our international student visitors, right? It doesn't matter who their spouse is. It doesn't matter where their spouse is. If they are married, they are still married. They are not single people just because they came to the United States. All right, filing status, head of household. So a person may be filing as head of household if they are unmarried or considered unmarried, and they provide more than half the cost of maintaining a household for themselves and a qualifying person. And that person must live in the same house with them. So essentially, that's going to be somebody, they're not married, they're taking care of usually a child, and they're paying the bills to take care of that child and for their household. All right. And to meet this test, they've got 3 criteria, right? Their marital status has to be right. Their housing situation, that paying for the household, they have to have a qualifying person. So on marital status, right, it's going to be unmarried or legally separated. You can, if you are legally married, you can still claim head of household if you did not live with your spouse for the last 6 months of the year. And they meet the other 2 criteria, and that the qualifying person is only their child, stepchild, or foster child. All right, this is why I say it's a little bit more complicated because there's lots of information here. For housing, they have to have paid the cost of keeping up their home for the year. It includes all of the housing expenses, so like rent, electricities, groceries, repairs, mortgage, real estate taxes if they own a house, all that kind of stuff. And the qualifying person must have lived in their home for more than half of the year. And but a dependent parent, if it's a parent that they're taking care of, they don't have to live with their taxpayer. Our resource 4012 has some really good flowcharts for how to figure out what a person's filing status is. All right. So when we get to actually figuring it out, which you will get to do so in a little quiz here shortly, in the next week or so, that is definitely where you want to go, is use that flowchart to figure out what their filing status is. All right, so a couple of examples. Jeremy is divorced and paid for the cost of keeping up his home. His son lives with him and he takes care of his son. Is his filing status going to be head of household? The answer would be yes. All right. On the other hand, if Jeremy's paid for his house, but his son only lived with him in the summertime, that would be only 3 months. That would not meet the criteria for head of household because his son was not with him for at least 6 months. He would have to file as single, is how he would have to file. All right. File a joint return. So married filing jointly. So if you are married, you can choose to file a joint return. This is your option. You can choose to do it if you want to. If the spouse died during the tax year, then whoever is the surviving spouse, they can also choose to file a joint return with their spouse, even though they are no longer living. For someone whose spouse passes away after the end of the year, they can still file a joint return. They can, oops, what in the world is going on here? They can only file that return if they did not marry before the end of the year. So for example, the spouse dies in January of 2024, taxpayer files in February 2024 for 2023, they can file as a joint return since the spouse was alive at the end of the year. Next year, they would not be, if they haven't remarried, they would potentially be either single or qualifying surviving spouse, depending on whether they have a child. All right. If married taxpayers divorce, they have to have court documents to prove their separation for their filing status change. And if they are filing joint, but they don't live together at the end of the year, then they have a different filing threshold. Instead of saying you have to file if you have more than, say, $25,000 of income, the actual amount is $5 of income. So they have to file more returns. A married couple can choose to file separately instead of filing a joint return together. Sometimes that can be advantageous, but there also can be challenges around this because generally the law encourages people to file a joint return. So this means there's a higher tax rate and there are a bunch of credits that they are not eligible for if they do this. And this is the list of those credits here. And again, the threshold is $5 for filing. So it is generally better to file a joint return. But if they want to choose to file a separate return, that's no problem. They can do that as well. They just can limit their ability to claim some credits. All right. So for the first 2 years after a spouse has died, the surviving spouse who has children may use a qualifying surviving spouse status. This basically, to be able to do this, they had to be eligible to file a joint return, even if they didn't file a joint return. They cannot have remarried, and they must have a child that lives with them that they could claim as a dependent, or if they don't claim as a dependent, that they at least had gross income of $4,700 or more because they filed a joint return, or they lived in the home all year rather than just half of the year. So generally the idea for this one, right, is somebody's spouse died, they're still taking care of the children, they get an advantageous tax filing situation where they get a higher standard deduction and they still get the same credits that a filing joint person would be eligible for. Right? They also have to have paid more than half of the cost of keeping up their home for the year. Generally, in our tax clinics, right, we're seeing mostly college students, occasionally college teachers and researchers. Usually, a lot of our individuals are single. There's a decent number of folks that are married, few folks that have children as well, all right? So we definitely see most of these. It is not very common for us to see a qualifying surviving spouse. But that does very rarely happen. So everybody needs to be aware of it. All right. Hiding and hiding. Okay. All right, let's talk about the impact of the filing status. So it can impact the return in a couple of different ways. If you're single, it impacts your tax bracket. So like how much income you earn at the 10,000 and 10% versus how much income you can earn at 12%, how much income you can earn at 24 and on from there. Head of household also affects your tax brackets and your standard deduction. It offers a lower bracket as well at the 10% and 12% as well. Married filing jointly allows both spouses to do their income together. So they just like add all of the different types of income together. And the standard deduction and the bracket limits are basically twice what the single filer has. For married filing separately, each spouse can file separately, but that puts them in generally different brackets than the married filing joint or single. Again, there's a bunch of credits that they can't get, and they also can get taxed on Social Security income. But you cannot file as single if you are married, right? If you are married, you have to file as married, even if it's not great. And then qualifying surviving spouse has the married filing joint tax bracket and standard deduction. So it's definitely a better way for them to go. All right. Any questions on that? right? So basically there are 5 different types of filing status. For some of those, you have to have a dependent, in particular, the head of household and the qualifying surviving spouse. You have to pick one of them. Sometimes you can choose, right? Married filing joint or married filing separately. It affects your tax return, how much money you're going to pay, whether you actually even have to file a tax return. That's kind of the summary of the situation. All right, there's a bunch of links here for additional resources, little guides about how to do this. And then publication 48012, like I said, has a really good little flow chart that helps walk you through who can file as a head of household, who can file as surviving spouse, all that kind of good stuff. All right, the next topic we're going to talk about is dependents. So what are they? Who qualifies? What effect do they have on the tax return? All right, so what is a dependent, right? So a dependent is somebody other than the taxpayer or spouse. So a spouse is never a dependent. Spouse is never a dependent. Even though the visa, they might be on a dependent visa, they're not a dependent for tax purposes. So somebody other than a taxpayer or spouse who can claim a dependency exemption, right? Again, this is that one where I said the tax law changed. Right now, those exemptions are worth $0. In 2025, that may change again, but for right now, there is no deduction for exemptions on the tax return. They basically rolled that amount into the standard deduction. I do not know why my computer is doing that. Let's see here. All right. So, however, claiming a dependent can affect some tax issues like a status or credits. Some credits, you have to have a dependent to be able to claim them. There are a number of tests that you have to pass in order to qualify. There are kind of 2 categories of dependents. The first category is qualifying child. And the second category is qualifying relative. All right, let's talk about both of those. All right, so to be a qualifying child, there are 5 tests. They are relationship, so they have to be your son, daughter, stepchild, foster child, or descendant of any of those, or your brother, sister, half brother, half sister, stepbrother, stepsister, or dependent of those. So basically think of it as like your level of generation and down, but it cannot be somebody that's higher. Their age must be either under 19 at the end of the year and younger than you, or if they are a full-time student for at least 5 months out of the year, they have to be under age 24 and younger than you. Or they can be permanently and totally disabled, independent of their age. This is the one that also gets our non-resident alien folks, right? To be a qualifying child, they must also be a citizen, resident alien, national, or a resident of Canada or Mexico. So somebody that is here as a non-resident alien, a child, cannot be a dependent if they're a non-resident alien. They must have lived with you for more than half the year, though there are some exceptions for temporary absences. Children who are born or died, kidnapped children, or children of divorced and separated parents. The big exception for us, right, is school. Generally, education is considered a temporary absence. The support test, so the child can't have provided more than half of their own support, and the child can't provide or can't file a joint return for the year. So if they meet all of those tests, they could be your qualifying child. If they don't meet those tests, then they might be a qualifying relative. There are 4 tests there, and the first one is that you're not a qualifying child. The second one, it must have either be a member of your household or you have a relationship. So that household means that they lived with you all year as a member of your household, or they must be related to you in one of the ways listed under this list that I'm not going to copy here because it's a little bit longer. And if at any time that person was your spouse during the year, they cannot be a qualifying relative, right? Because remember, a spouses cannot be a dependent. So, and a qualifying relative is a kind of a dependent. To be a qualifying relative, their income must have been less than $4,700, and they must, the taxpayer must have provided more than half of their support for the year. All right. So those are the criteria to be a qualifying relative. So 2 kinds of dependents: children, qualifying child, qualifying relative. All right. Here's a list of all those good things. We're going to skip over those, let you read those later. All right, there's even more notes. Again, this is why 4012 is so long, is because it has a bunch of good guides for you on that. So what impact do dependents have? All right, so there are some really good things, right? There's a child tax credit, which is up to $2,000 for every child up to age 17. There are education credits, which can be up to $2,500. You can also get a bigger standard deduction, such as the head of household filing status, which takes your deduction up to $20,800, right? So it definitely can be beneficial to have a dependent on your tax return. All right, so that's all that is to it. Basically, just to review, there's 2 ways to be a dependent. Qualifying child, there are 5 tests. Qualifying relative, there are 4 tests. They all are about relationship, age, residency, like where you're living, support, and then joint return and filing a tax return. All right. There's another calculator here that's from TaxAid Colorado, which you guys are welcome to use as well. I would encourage you to go check that one out. All right. The one thing that I'm going to say here, right, is that dependency is complicated, right? You saw that list of things. It's not exactly easy to figure out. It's especially important for a lot of our clients, right? Because they're right in that range, right? Most of them are students. Most of them are in that 19 to 24 age range. So when we look at it to say, okay, are you a dependent? Are you not a dependent? We would ask them and walk through the test for a qualifying child first, right? Do they have a parent still? Are they meeting the age requirement? Where are they living, right? Do they still have their stuff at mom and dad's house? Or have they, permanently moved out? Are they getting support from mom and dad? Or do they do all of their school expenses through loans? Are they filing a joint return? Are they married and filing a return with somebody? If they're not a qualifying child, then see if they're a qualifying relative, right? This one, the quick one, go look at their total income, right? If their income is over 4,700, they can't be a qualifying relative, right? They're done with that one, and that means they're not a dependent. And then their status affects their credits, and the status of a dependent affects the credits for the person that would like to claim them and get that $2,000 child tax credit. All right. That is dependence. Does anybody have any questions about those? I know that was a relatively quick. So I would say that, yeah. So these are the hardest parts, right? Because this is like trying to figure out which in these sets of rules applies for this individual. So when I look at filing status and I look at dependence, right? Again, I'm going to come back to the reference materials, the 4012. They have some really good flow charts that walk you through what is this person's situation? What are they going to be? Who can claim them? All of that. The practice problems that you guys are going to do also give you some additional practice in looking at that. What criteria do they have? Do they meet? What is going to be their best filing steps? All right. Okay. All right. Well, that is all that I actually wanted to cover for you guys today. So it was relatively quick. So we'll be out of here an hour early, which is awesome. Okay. So when you fill out the volunteer data, there's a quiz. The very first thing in the non-resident tax Moodle course, there is a quiz about volunteer data. And on that, there's a question where you can say, do you want to be a general volunteer and do non-resident tax only? Or do you want to be an advanced volunteer and also study the resident stuff? If you say, yes, I want to be advanced volunteer and train on resident taxes, I will use that result and I will send you the invitation to the resident training course, okay? Again, same reasons for why we're doing this. We will have 2 modules that you will have to complete, not 4. So there will be a filing status one and a dependence one as well. All right. And then again, we'll let everybody know about the software when it's available. All right. Okay. So that's that. that. I'm going to stop recording. There we go. All right. Everybody out.